Imagine having the power to acquire the assets your business needs without breaking the bank. Welcome to the ultimate showdown between finance leases and borrowing to buy. In this video, we reveal the shocking truth about finance leases and help you decide which option is best for your business. Will you choose the flexibility of leasing or the ownership of buying? The choice is yours. But first, let's dive into the world of finance leases and uncover the secrets that can make or break your business financial future. Feel free to adjust it to fit your style and tone. Let's go. What is a lease? A lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. A contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. That means the lessor conveys the asset to the lessee for use, and the lessee pays the lessor the consideration for enjoying the asset. So in my first video, I've examined an operating lease. In this second video, I want to examine the finance lease. Finance lease. What is a finance lease? A finance lease is a long-term, non-cancelable lease agreement in which the risk, reward, or benefit of ownership is immediately transferred to the lessee. A long-term, non-cancelable lease agreement, that is, it cannot be cancelled, in which the risk, reward, or benefits of ownership is immediately transferred to the lessee. So, what are the features of finance lease? Features. Number one feature is that it is a long-term lease. It is a long-term lease. So, the number two, it cannot be cancelled. Neither of the parties to the lease can terminate the terms of the lease agreement without any penalty. Neither of the parties, that is, neither the lessor nor the lessee, can terminate the term of the lease agreement without penalty. So, that is why we say it is not cancelable. We said the risk, number three, the risk, reward, or benefit of ownership is transferred to the lessee. That means the lessee will be the one that will be responsible for the insurance and maintenance of the lease asset. So the insurance cost, the maintenance cost of the asset will be borne by the lessee. So a finance lease is a balance sheet event. That is why it can be recognized as a tangible, non-current asset in the statement of financial position of the lessee. It is a balance sheet event. So for a finance lease, the lease period, that is number 5, the lease period covers substantially the economic life of the asset. That is, the economic life of the asset and the lease period are very close, or they may exactly be the same. The lease term may be 4 years and the economic life may be 5 years, or both the lease term and the economic life may be 5 years. So that is for the case of a finance lease. Then not that you will have the economic life to be 20 years and you'll be having the lease term to be 5 years. No, if that happens, that means the type of lease involved is an operating lease. So the lessee can purchase the asset at the expiration of the lease agreement. So at the expiration of the lease agreement, the asset may be purchased by the lessee. So that is another feature of a finance lease. I've told you the fair value and the cash price of the asset may be closed, if not exactly the same. The two may be the same or it may be closed. If there will be little, if there will be a margin, the margin will be very small. It will not be very wide. These are some of the features of finance lease. But my focus in this video is financing decision. That is how to use a lease as a method of finance. So if you have watched my earlier video, my first video, where an operating lease was examined, so I've told you that in financing decision that there are two phases. In lease or buy decision that two phases are involved. Two phases are involved. Phase one, I've told you the phase one is acquisition phase. Acquisition phase of the project. Acquisition or investment phase. Investment phase. So this involves the calculation of the NPV of the project. That is, you want to make decision. Is this project financially viable? I've told you it is when the NPV is positive that you can proceed to financing phase of the project. There are two phases are involved. The first one is acquisition phase. That is, under the acquisition phase, that you want to assess the viability or otherwise of the investment project by computing the NPV of the project. And I've told you it is when the NPV is positive that the project worth financing. But if the NPV is negative, that the project does not worth financing. So if the NPV is negative, you don't need to proceed to financing phase of the project. But if the NPV is positive, then you will need to proceed to the financing phase. That is, you want to determine the appropriate method of finance to use. That is financing decision or financing phase of the project. So for the purpose of this lecture, we want to examine two methods of finance. Number one is borrow to buy. Borrow to buy. You want to borrow money to buy the asset. If you want to borrow money to buy it, so that is one phase. Another one is leasing. Leasing. You want to determine whether the asset should be leased. So if you want to consider this phase, borrow to buy the assets, what are the relevant cash flows? What are the cash flows associated with this option? That is, options of borrow to buy the asset. Number one cash flows to consider is the purchase price of the asset. Purchase price of the asset. The purchase price of the asset, which is usually the amount borrowed. This is usually the amount borrowed. The amount of the loan. That is usually the purchase price of the asset. That is the number one cash flows to consider. So, and this will be used as an outflows in year zero. And the second one is the disposal process. Disposal process, that is the scrap value of the asset. And this will be used as an inflows at the end of the project life. So that is the disposal process. Then we could have tax savings on capital allowance. Tax savings on capital allowance. Tax savings on capital allowance. That is another relevant cash flows to consider when you want to make the decision as regards borrow to buy the asset. Maintenance and operating costs is another one. Maintenance and operating cost. Operating cost. Maintenance and operating cost. Of course, you can have tax relief. Tax relief on maintenance and operating cost. Tax relief on this. So these are relevant cash flows to use in connection with borrow to buy decision. These cash flows, you discount the cash flows using the post-tax cost of borrowing. Discount the cash flows using the after-tax cost of borrowings. You use the post-tax cost of borrowings to discount all these cash flows. The second option we want to consider is leasing. So what are the relevant cash flows to consider? Number one is the lease renter. Lease renters. That is the periodic payments that will be made in connection with the lease. Remember, under the operating lease, we said there will be tax savings on the lease renter, but we don't use to expense the lease renters in the case of finance lease. The lease renter should not be expensed because we don't use to expense the lease renter. It is the lease interest that will be expensed. And that lease interest that will be expensed is the amount that will reduce the amount of profit. Since the profit will be reduced by the lease interest, that means the tax payable or to be paid will reduce. So you can have tax relief on the lease interest. Tax relief on lease interest. That is another cash flows. Remember, I've told you that finance lease is a balance sheet event. Since it is a balance sheet event, then that means an asset is recognized, tangible non-current asset, which will be depreciated. So that means you could have tax savings on capital allowance, tax savings on capital allowance. Tax savings on capital allowance is another relevant cash flows in connection with this. Maintenance and operating costs is also another relevant cash flows. Maintenance and operating costs. So that is another relevant cash flows. Of course, the maintenance and operating costs. That is if it is not part of the lease renter. So you could have maintenance and operating costs where this is not part of the lease renter. But if it is part of it, then that means you will not need to separate that. Then you could also have tax relief on that. Tax relief on maintenance and operating cost. Tax relief on maintenance and operating cost is another relevant cash flows. Then these cash flows, you also discount it using the post-tax cost of borrowings. So you discount the cash flows, discount the cash flows with after tax cost of borrowings. Use the after tax cost of borrowings to discount the cash flows in connection with leasing option. So, having examined, but remember, I've told you that it is tax relief on lease interest. How do we calculate the tax relief on the lease interest? I want to give you the format for calculating the tax relief on lease interest. So, calculation of tax relief on lease interest. To calculate the tax relief on lease interest, you prepare the lease amortization table. Calculation of tax relief on lease interest. You use what? Lease amortization table. So the lease amortization table can be done in two ways. One method is where the renters are payable in arrears. Unless otherwise stated, the lease renters are payable in arrears. Unless otherwise stated, the lease renters are payable in arrears. where the renters are payable in arrears, that means the renters are payable at the end of each of the years. So number one is where renters are payable in arrears. I've told you the renters are payable in arrears where they are payable at the year end. So where the renters are payable at the end of each of the years, you have year. This is the amortization table. You have year. You have opening balance. You have lease interest. Or you put finance cost. You have lease renter. Or you put lease payment. Then you have the closing balance. This format is used where the renters are payable in arrears. Number two, where the lease renters are payable in advance. That is where the renters are payable at the beginning of the year. So to prepare the amortization table, you have a column for year. You have opening balance. You have lease renters, or lease payments. You have the principal element. You have lease interest or finance cost. Then you have closing balance. That is the finance lease amortization table where the renters are payable in arrears and where renters are payable in advance. Now, having examined the calculation of the lease interest, I want to consider the interest implicit in the lease. Interest rate implicit in the lease. Interest rate implicit in the lease. You may be asked to calculate this in exams. So, interest rate implicit in the lease is the rate that equates the present value of the lease payments to the fair value of the lease asset. The rate that equates the present value of the lease payments to the fair value of the lease asset. If where the rate is given, or the proposed interest rate implicit in the lease, where it is given, just apply the rate to calculate the present value or the net present value. Use the rate to calculate the NPV where the proposed rate is given. The proposed rate is given in the question. Use the proposed rate to calculate NPV. So the rate that equates the NPV to 0 is the interest rate implicit in the lease. The rate that equate NPV to 0 is the interest rate implicit in the lease. So, I've told you use this rate to calculate the NPV, where the proposed rate is given. So, where the rate to use is given, use it, and if it gives you 0 NPV, then that means that rate that gives 0 NPV is the interest rate implicit in the lease. So the relevant cash flows for this cash, or let me consider the second situation, where the proposed rate is not given. So you calculate IRR. So remember, to calculate IRR, 2 different rates will be assumed, and those 2 rates will be used to calculate the NPV, and one must give positive, the other one negative. And when you get the NPV positive and negative, by interpolation, you calculate the IRR. So the IRR, internal rate of returns by interpolation, equals to lower rate plus NPV at lower rate over NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. The NPV at lower rate is always positive. That means this will always be positive NPV. And the NPV at higher rate is always the one that will give you a negative figure. This minus and the minus that one carries, we change this one to plus. So this is the formula for calculating the IRR. So the IRR obtained is the interest rate implicit in the lease. Having examined all this, so let's take a question as work example. Keep watching. Example. This question is obtained from Workout Financial Management, FM. And the same question can be found in Workout Strategic Financial Management, SFM, as well as ACCA past question. So the question will find that TT Limited is an agric firm with specialization in yam and rice production in Benue State of Nigeria. One of the harvesters is due to be replaced on 30th of November 2024, the last day of TT's current financial year. An investment appraisal exercise has recently been completed, which confirms that it is financially beneficial to replace the machine at this point. TT is now considering how best to finance the acquisition of the replacement harvester. TT is already highly geared. A government development agency has offered the following 2 alternative methods of financing the machine. Alternative 1, a loan of 49.2 million at 6% interest rate to buy the machine on 30th of November 2024. If this option is selected, the machine will be depreciated on a straight line basis over its estimated useful life of 5 years. Then alternative 2, enter into a finance lease. This will involve payment of annual rental of 12 million naira, with first payment due on 30th of November 2025. The lease payments will be for the entire estimated useful life of the machine of 5 years. At the end of 5 years, ownership of the machine will pass to TT without further payment. Other information. The first asterisk. Whether leased or purchased outright, maintenance would remain the responsibility of TT and will be of the order of 450,000 naira payable annually in advance. The second asterisk, TT is liable to tax at a rate of 25% payable annually at the end of the year in which the tax charge or tax savings arises. The third asterisk, TT is able to claim capital allowance on the full capital cost of the machine in equal installments over the first 4 years of the machine. The fourth asterisk, assume that TT has sufficient taxable profits to benefit from any saving arises. Then we have the fifth asterisk, all workings are in thousand required. A, demonstrate that the implied interest rate in the lease is 7%. B, advise using present value method whether TT Limited should borrow to buy the machine or to lease finance it. So now let's solve the question. The first requirement, A, you have to demonstrate that the implied interest rate in the lease is 7%. To demonstrate that the implied interest rate in the lease is 7%, you are expected to calculate the internal rates of returns. Remember, the implied rate implicit in the lease, or the interest rate implicit in the lease, is the rate that equates the present value of the lease payments to the fair value of the lease asset. So that means you want to calculate the internal rates of returns. Now, what are the relevant cash flows? So to solve the A part of the question, solution A. In A, you have to calculate the implied interest rate in the lease. You want to demonstrate that the rate is 7%. Implied interest rate in the lease. You want to demonstrate that it is 7%. So what you should do, remember the internal rate of returns, we say it is the rate of return that equates the net present value to 0. That means you are expected to calculate the net present value. So at the inception of the lease, you were told a loan of 49.2 million. That is the value of the asset. So you have the year, then you equally have the cash flows. And your workings will be in 1,000. You know, the year 0, you have the outlay. Or let me have the items. Then cash flows. The outlay or the value of the asset, or let me just say the fair value of the asset, fair value, and that is 49.2 million. That is the value of the asset. You know the lease period is 5 years. So you have the lease payments. The annual lease payment is given to be 12 million. It is given to be 12 million naira. That is the lease payments, 12 million. So you discount it, the discount factor at 7%. So let's use that 7% to discount this. So for year 0, it's always 1. So the PV, the present value, 49.2 times 1, that will be 49.2 million. That is outflows. Then the lease term is 5 years. What is the cumulative discount factor over 5 years? you make use of an empty formula. 1 plus r raised to power minus n over r. If r is 7% and n is 5, so you have 1 minus 1.07 raised to power minus n, which is 5, over r, which is 0.07. So evaluate this. 1.07 exponential minus 5. So it gives us 0.712986 and so on. So if you subtract it from 1, then you have 0.2870 divided by 0.07. So we have 4.100. So the implied interest rate, the cumulative discount factor rather, is 4.100. So 12,000 times 4.100, that gives us 49.2 million. So the net present value will be nil. That is the NPV is nil. So the rate of returns, remember, I've told you that the interest rate implicit in the lease, I said it is the rate of return that equates the PV of lease payments to the fair value of the lease asset. So since both are the same, that means the NPV will be 0. So it shows that the implied interest rate in the lease is 7%. Therefore, the implied interest rate in the lease is 7%. Alternatively, you can calculate the IRR. Remember to calculate IRR. That means you want to disregard the 7% you are given in the question. You use two different rates of returns. One must give you the positive NPV, and the other one must give you the negative NPV. So by interpolation, you now calculate the IRR. So you will discover that the result obtained will be approximately equal to 7%. So if you want to use the IRR method, you can try 5% at first to discount it, anything you have as the NPV. If the NPV is positive, then you use another rate that is higher than 5% to calculate for the negative NPV. So now use interpolation, IRR equal to lower rate plus NPV at lower rate over NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So you use that formula. So to learn more about NPV, you can go over my earlier video on the calculation of net present value and internal rates of returns. So now we've done with the A part of the question. In the B part of the question, you are to demonstrate, in the B part of the question, you are to advise using the present value method whether TT Limited to borrow to buy the machine or to lease, finance it. So you have two financing options to examine. One option is to borrow to buy the asset. Another option is to lease finance the asset. So we want to start with the first alternative now. So the name of the entity still remains TT Limited. So we want to take the B part of the question. So you want to consider borrow to buy the asset and lease financing the asset. So we want to start with the borrow to buy option. Borrow to buy the assets. But remember, I've told you that before you can consider financing the asset, the first thing you should always consider is the acquisition phase. Does this investment worth financing? Does it worth investing in? Should the entity undergo the investment. I've told you the acquisition phase. You want to consider the viability or otherwise of the project. You were told the TT current financial year. An investment appraisal exercise has recently been completed. So that means they are done with the investment phase of the project, which confirms that it is financially beneficial to replace the machine at this point. That means the NPV associated with the investment phase of the project has been done. So, and the result obtained from the net present value is positive. So, since it is positive, that means it's what invest in. Financing option, borrow to buy the assets. What are the relevant costs of this option? Relevant costs. So you have the purchase cost of 49.2 million, outright purchase cost 49.2 million. That is, if you borrow to buy the asset, you will borrow a loan to the tune of this. Then, if this option is selected, the machine will be depreciated on a straight line basis over its estimated useful life. So the other relevant costs. So see, that means there will be tax savings on capital allowance. That is, if you want to borrow to buy the assets, you will have, apart from the outright purchase costs, there will be tax savings on capital allowance, since it will be depreciated on a straight line basis over its estimated useful life for 5 years. That means you will need to compute the capital allowance. So that is the first information we can obtain. These are the information you can obtain here. Now let's go through the other information. The first asterisk, whether leased or purchased outright, a maintenance will remain the responsibility of TT and will be of order of 450,000 payable annually. So this maintenance cost. It relates to lease or outright purchase. No, you purchase the asset outrightly if you borrow money. If you obtain a loan to finance it. That is why I said borrow to buy. So you will incur maintenance cost. Then you will also incur maintenance costs in connection with borrow to buy. Then the same amount will be incurred in lease financing the assets. So let me have maintenance cost as another cost that will be incurred. Maintenance cost of 450,000 annually will also be incurred in connection with borrowed to buy the asset. Then you were also told that TT is liable to tax at the rate of 25% payable annually at the end of the year in which the tax charge or tax savings arises. You know, the maintenance cost leads to tax relief. There will be tax relief or tax savings on maintenance costs. So tax relief on maintenance costs. You know, maintenance cost will be expensed in the statement of profit or loss. Since it will be expensed, that means it will reduce the amount of tax that will be paid. That is why you will have tax relief on maintenance cost, since you have it here. So as part of the cash flows, so it will lead to tax savings or tax relief. So now, if you look at the next asterisk, TT is able to claim capital allowances on full capital cost of the machine in equal installment over the first 4 years of the machine. That means you can claim capital allowance even if the asset is financed through borrow to buy or is lease financed. So that means you can have capital allowance in connection with financing option as well. Assume that TT has sufficient taxable profits to benefit from any savings arises. So these are the relevant cash flows in connection with borrow to buy the asset. Now, to lease finance the asset, lease finance the asset through finance lease. Finance lease option. What are the relevant cash flows? Now, let's go through the information we have in alternative 2. So, alternative 2, we were told to enter into a finance lease. This will involve payment of annual rental of 12 million. So, the relevant cash flows in connection with the lease option, we have the annual rental. So, relevant cost or relevant cash flows. We have number 1, we have annual rental. Rentals of 12 million every year. Then aside that, with first payment due on 30th of November 2025, the lease payments will be for the entire estimated useful life of the machine of 5 years. At the end of 5 years, ownership of the machine will pass to TT without further payments. You know, this is a finance lease. The rentals will not be expensed in the statement of profit or loss. Since rental will not be expensed, so it will be wrong to charge tax relief on rentals. But if it were an operating lease, the rentals will be expensed, then you will need to claim a tax relief on the lease rental. But since this is a finance lease, what we normally expense in the statement of profit or loss in connection with the finance lease is the lease interest. So, and the lease interest that will be expensed will reduce the amount of tax you will pay, because it will reduce the profit you have in the statement of profit or loss. Therefore, the tax relief on the lease interest will form part of the cash flows. So, tax relief on lease interest is another cash flows. So we have here. Now remember, this is a finance lease, and a finance lease is a balance sheet event. Being a balance sheet event, it means in the book of the leasing, the rights of use asset will be recognized. Since you are going to recognize a right of use asset, which is a tangible non-current asset, then you will depreciate it. Therefore, it means you also have the capital allowance, which is the equivalent of depreciation, which will also reduce the amount of tax that will be paid. So you can have tax savings or tax relief. Tax savings on capital allowance. So tax savings on capital allowance will also form part of the cash flows that will be used in lease financing decision. You were told whether lease or purchase outright, maintenance costs will remain the responsibility of TT and will be of order of 450,000 payable annually in advance. So that means maintenance costs forms part of the relevant cost. So maintenance costs of 450,000 naira will form part of your relevant cash flows. And the maintenance cost, since it will be expensed in the statement of profit or loss, then that means maintenance costs will also lead to tax relief. Tax relief on maintenance costs. Now, if you look at the cash flows associated with borrow to buy option and lease financing, what are the common cash flows? common cash flows. You can strike out those ones that are common to both options. You may choose not to include the common cash flows in the relevant cost. So the common cash flows include, so we have tax savings on capital allowance. So we also have tax savings on capital allowance. That is common. Tax savings on capital allowance. The one that is common to both, I am striking them out. Tax savings on capital allowance, I strike out that. Then maintenance cost of 450,000, maintenance cost is common. Maintenance cost of 450,000 is common to both. So I will also strike out that maintenance cost. I will strike that out. Then tax relief on maintenance cost. Tax relief on maintenance cost is also common. Tax relief on maintenance cost so I will also strike that out. Tax relief on maintenance cost, I will strike it out. Then in borrow to buy, you are left with only the purchase cost of the asset. The purchase cost is the only thing you are left with under borrow to buy. But in lease financing, the cash flows include the rentals of 12 million per annum and tax relief on the lease rental. So you will not discount these cash flows. For borrow to buy option, we have net relevant cost or cash flows is 49.2 million naira. That is the only relevant cost we have for that option. For the alternative two, which is leasing. So you have year, you have items, you have cash flows. The first year, the lease term is 5 years. So your cash flows include the rentals of 12 million. Year 1 to 5, since it is payable annually. So you have rentals of 12 million naira. Then the other cash flows is tax relief on lease interest. And you are not given the lease interest. Therefore, you will need to calculate the lease interest. And what is the time lag in the payment of tax? So we need to find out that TT is liable to pay tax at the rate of 25%, payable annually at the end of the year, in which the tax charge or savings arises. That information is obtained in the second asterisk. That is, TT is liable to pay tax. TT is liable to tax at a rate of 25%, payable annually at the end of the year, in which the tax charge or tax savings arises. So the tax payments or tax savings is payable the same year in which they arise. So it means since tax are payable the same year, that means the time lag in the payment of tax will be year 1 to 5. So we have year 1 to 5, that is tax relief, or if you like, capital savings. Tax relief on lease interest. So to calculate this, you will need to calculate the lease interest. Calculation of lease interest working, which is calculation of lease interest. To calculate the lease interest, you use the amortization table. And you were to enter into a finance lease. So, since they enter into a finance lease, this will involve payments of annual rentals of 25 million with first payment due on 30th of November 2025. The lease payment will be for the entire estimated useful life of the machine, which is 5 years. At the end of the 5 years, ownership of the machine will pass to TT without further payments. So I told you where the times lag in the payment of interest or rentals is not specified. You assume that the rentals are payable at the end of the year. Alternative 2, enter into a finance lease. This will involve a payment of annual rentals of 12 million naira with first payment due on 30th of November 2025. The lease payment will be for the entire estimated useful life of the machine of 5 years. At the end of 5 years, ownership of the machine will pass to TT without further payment. Now, the time lag as to the payment of the lease renter is not specified. You are not told whether the payments are made at the end of the period or end of each of the years or not. And I've told you that where the time lag as to the payment of the lease renter is not stated in the question, you should assume that the rentals are payable at the end of each of the years. So your amortization table will appear just. Amortization table. You need to prepare the amortization table to calculate the amount of the lease interest payable at the end of each of the years. So you have here, you can have the opening balance. You have the lease interest, or you put finance cost. You have lease payments, or you can put rental payments. Then you have the closing balance. I remember amounts are in 1,000 naira. 1,000 naira. 1,000 naira. Thousands of naira. So now the principal cost, the cost of the asset is 49.2 million. So that will be used as the opening balance in year 1, 49.2 million, which is the fair value of the lease asset. You use the fair value of the lease asset as the opening balance. The lease interest, you use the interest rate implicit in the lease, which is 7%. So we have confirmed that in the A part of the question. What is 7% of 49.2? That gives us 344. 3,444. 3,444. You know, the other rental payment is 12 million. So opening balance plus the lease interest minus the rental payments plus 49,200 minus the rental pay of 12 million. Then the closing balance at the end of the first year is 40,644,000. This opening balance in year 1, the closing balance in year 1 becomes the opening balance in year 2. So you have 40,644,000. What is 7% of that? 7% of that gives us 2,845,000. 845. So you subtract the rentals of 12 million. So if you add this plus this minus this, plus 40,644 minus 12 million. That gives us 31,489,000. That becomes the opening balance in year 3. 31,489,000. Then the 7% of that, so which is 2,204,000. The rental paid of 12 million, opening balance plus interest minus rental paid, 31,489 minus 12 million. Then you have 21,693,000. In year 4, the closing balance becomes the opening balance. The closing balance in year 3 becomes the opening balance in year 4. 21,693. So the interest at 7%, that gives us 1,519. 1,519,000. So the renters paid. So plus 21,693 minus 12,000. That gives us 11 million to 12. Year 5, 11 million to 12. You know, the renters that will be paid is 12 million. So you want to liquidate this. You can just find the difference between the two balances, or you calculate 7% of this. But remember to compensate for a rounding of error, if any. So 784. By the time I calculated 7% of this, I got 784. But what I need, let's look at the difference. So I want to compensate for the rounding of error, if any. 11,212 minus 12,000. 78788. So this have to be increased by 4. So the difference of 4 is as a result of rounding off. So this 788 is just the difference between this and this. But when you calculate 7% of this, it gives you 784. So you have difference of 4. The difference of 4 you have is as a result of a rounding off error. Now that you have computed the lease interest, then how much will be the tax relief that this lease interest will give the entity? You have 5 years. So yes, calculation of tax relief on lease interest. Let me call this one working 2. If this one is working 1. So we have 5 years. Year 5, year 4, year 3, year 2, and year 1. So these are the years involved. So the interest payable in each of the years. Year 1, 3,444. Year 2, we have 2,845. Year 3, we have 2,204. Year 4, we have 1,519. And in year 5, we have 788. Then you apply the tax rate, tax relief. At what is the tax rate? You are given 25% in additional information under the second asterisk. What is 25% of 3,444? That gives us 861. 861. That is the tax relief on that lease interest for year one. 2845 times 25%. That gives us 711. 2204 times 25%. That gives us 551. 1519 times 25%. That gives us 380. Remember, I didn't calculate lease interest in my first video because that one is operating lease. It is the lease rental that will be expensed in the statement of profit or loss. That is why we only calculated the tax relief on the rentals, not on the lease interest. But this one is finance lease. Rentals will not be expensed in the finance lease. It is the interest that will be expensed. Therefore, it is the interest that will be expensed in the statement of profit or loss that will attract the tax relief, not the entire rentals. So 788, 25% of that, 197. 197. Since the tax relief for lease rentals are not the same over the lease period, so you cannot group it like this. So the workings have to be done 1 year after the other. So we have year 1 to 5. Then we have year 5, year 4, year 3, year 2, year 1. So we have years. And amount is in thousands of naira. 1,000. So the renters is the first item. Renters of 12 million. Renters will be paid and now flows 12 million, 12 million, 12 million, and 12 million for each of the year. Then we have tax relief on interest. Tax relief on interest. That is our working tool. So for year 1, we got 861. 861. Year 2, we have 711. Year 3, we have 551. Year 4, we got 380. Year 5, we have 197. So, these are the relevant cash flows. Remember, the common cash flows, that is, the cash flows that are common to both methods of financing, that is, the cash flows that are common to the two methods of finance, that is, borrow to buy and leasing, have been eliminated. So the only cash flows that were considered in our calculations are those ones that are not common to both cases. 12 million minus 861, you have 11,139. That is your net cash flows. Then the second year, 12 million, 711. Then we have 11,209. The third year, 12 million minus 551. So we have 11,449. And the fourth year, we have 12 million minus 380. That is 11,620. 620. All these are negative. The fifth year, 12 million minus 197. So we have 11,803. So we now discount these cash flows using the discount factor. The post-tax discount rate. So remember, I've told you after tax cost of borrowings should be used. The interest rate given in alternative 1 is 6%. Yes, 6%. That is the interest rate. You were told an alternative 1, a loan of 49.2 million at 6% interest rate. And I've told you that you use your after-tax cost of borrowings. The cost of borrowings is the interest rate. What is the after-tax? Post-tax. 6% into 1 minus tax rate. Tax rate is 25%. So that will give us 0.75 times 6. We got 4.5%. 4 equals to 4.5%. So you discount the discount factor at 4.5% for year 1. 4.5 divided by 100, 0.05 plus 1. Year 1 is 0.957. 957 approximately to 3 places of decimal. Year 2 is 0.916. 916. Year 3 is 0.876. 0.876. Year 4 0.839. Year 5 0.802. 0.802. What is the present value of the cash flows? So the PV, that will be the net cash flows times the discount factor. 11,139 times 0.957. That gives us 10,666. 10,660. 10,660. For year 2, 11,209 times 0.916. That gives us 10,267. 10,267. 11,449 times 0.876. That gives us 10,029. 10,029. 11,620 times 0.839. That is 9,749. 9,749. 11,803 times 0.802. That gives us 9,466. 9,466. So you sum up all these PV. So what is the total of all this? 10,660 plus 10,267 plus 10,029 plus 9,749 plus 9,466. So the total is 50,171. 50,171. So the net present value of lease option. Lease option is 50,171,000. So this is greater than the net present value of borrow and buying option of 49.2 million. So what will be your decision now? Decision will be to borrow and buy the asset. So decision, so borrow to buy the asset. So it is cheaper. The borrow and buy option of 49.2 million is lower than leasing option of 50,171,000. So this marked the end of the solution to the question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA. Bye for now.